Hi everyone, thank you for joining us today. Today's webinar is on PPP loan forgiveness and tax considerations for the construction industry, presented by Dan Mayo, Frank Boutillette, Ron Martino, Joe O'Drain, and Kim Hullfish. Before we begin, I have a few housekeeping notes. Materials for today's presentation can be found in the toolbar located at the right of your screen for you to download. Also at the bottom of the toolbar, you'll see a question box. Feel free to send us your questions during the presentation. We'll do our best to address them. There will be 4 polling questions throughout the program. To qualify for CPE credit, you must participate in the polls. Please be sure to answer the polls at the time they are launched. If you're having trouble submitting your answers, please ensure that you are not in full screen mode and then stretch the presentation to see the submit button. If you still cannot submit your answer that way, please submit your answer into the question box. Make sure to answer polls when they are on the screen during the presentation. CPE certifications will be emailed to you, as well as a copy of the webinar recording and the slides. And finally, once the webinar is over, there'll be a pop-up asking you to complete a survey of today's webinar. Please take a moment to complete it. It is our best way to be able to provide you with the best and most relevant programs possible. So with that, I'm going to hand it over to Kim Hullfish from CFMA South Jersey.
Welcome, everybody. I'm Kimberly Hullfish. I'm the controller at Abbonizio Contractors, and I've worked here for about 18 years. I've been a member of CFMA probably since about 2005, 2006, and I'm a previous president of the South Jersey chapter. If you're a CFMA member, it's great to quote-unquote see you again virtually. If you're not a CFMA member, please contact either myself or Faith McDermott, the current president of CFMA, and we'll be happy to get you more information. It's nice to have you here, though. This fall, we plan on having a bunch of virtual meetings. This is our second one, and we're learning through all of this as you are. But our topics will include umbrella and health insurance markets, what to expect since the COVID-19 is making the markets go crazy right now. CSIPs, what contractors need to be aware of. Tax audit update, and a type of banker shootout that focuses on the local economy and what to expect in 2021 after we all go through this. I want to give a shout out to Drew Garris, who's not on the call. He's on vacation, but he helped put this all together for today, and without him, it would have been difficult. So he did a great job. And then Faith McDermott, our president. What a year to be president of a chapter. There's so many changes with COVID-19, and we want to stay in everybody's radar and help everybody any way we can. And if you need anything, email anyone on the board and we'll try to help you through it. So with that, I'll hand it over to Frank.
Great, thank you, Kim. Thank you everybody for attending. We're happy to be here. I'm Frank Boutillette. I head up our SBA financial assistance team with Withum. I have Dan Mayo, who also assists me in that area, and Ron Martino and Joe O'Drain, who are both in the construction industry and head up our South Jersey construction niche. Please, visit our website, withum.com. We have a lot of information that we're going to talk about today, but a lot of articles and information that you can find on our website. It's a great place to go. Dan and I have been dealing with this since before it actually was passed, the CARES Act. FAQs came out just the other day, and it came out yesterday morning, and by noon, Dan had an article out summarizing it. So we stay on top of this and all the changes. So a good place to start would be to go to our website. Next slide, please. Our disclaimer, and this is just a general disclaimer that this is our information we're giving. It shouldn't substitute for individual tax advice or from a tax qualified advisor, because your questions may be specific, and this is more general. So, but if you have any questions, by all means, reach out to us, and we're here. We're here to help you and get you through this process. Next slide, please. So the agenda for today, we're going to cover the loan forgiveness. You see the areas we're going to cover: payroll, non-payroll costs, FTEs. Then we're going to get into some taxation of the loans, and Dan will talk about that. Dan is a tax expert. I'm on the audit side, and then we're going to get into the accounting treatment of the loans and the forgiveness of the loans, and that's where Joe and and Ron will take care of, and then Kim will hold up the back end, talking about the emergency sick pay and expanded family medical leave. So that's our agenda for today. We're going to go kind of quick because we want to leave a lot of time at the end for questions, because I find that as much as we give you, you're going to have specific questions, and that's where I think our most value will be, is answering your specific questions. So without any further ado, we go to the PPP. This is just a rundown of all the things that have occurred. You know, the CARES Act was passed on March 27th. The application process opened on April 3rd, and then they ran out of money of the funding. Or actually, they run out of money, but they kind of on the EIDL side, which we're not covering, ran out of money at one point. They had on June 5th, the Flexibility Act came out, which changed some of the rules, which we're going to talk about, and all the way down. The last bullet, though, that I want to just mention, or 3 bullets, is there were 5.2 million loans given out through August 8th, because they closed the process on August 8th. 87% of the loans are under $150,000, and 95% of loans are under $350,000. So right now, and I think Kim will touch on this, is why not filing for forgiveness now, or why banks aren't taking the applications. I know we've been in touch with a lot of banks to try to help them with this process, and a lot of them are holding off because we're not sure where the SBA is. The issue with the SBA is, I personally think that different people wrote different sections of the law, and they didn't talk to each other. So you'll notice that there's a lot of FAQs that come out. I think they're up to 52 FAQs. There's been about 17 to 20 IFRs, interim final rulings, that have come out to just kind of explain some of the issues that have that are arising. And as the law was written, is very vague to understand, and there's a lot of judgment in a lot of it. And hopefully, some things are getting cleared up as we go forward. But hopefully, that this session will help you unmuddy some of the information that's out there. So next slide, please. So the Flexibility Act of 2020, which was passed on June 5th, what this did was it changed the covered period. So any loans that existed before June 5th, you had an 8-week covered period, and that started the day that you got the loan. The Flexibility Act said we're going to increase that to 24 weeks, because a lot of businesses were saying I couldn't open, I couldn't use all the money. So they allow you to have 24 weeks. If you got the loan before June 5th, you have the option to use 8 or 24. And there's some reasons why you might want to use 8 weeks. We have a lot of clients that are trying to sell the business right now, and their loan agreements call for not having this debt outstanding, or some covenants that they have. So they want to close out the loan as soon as possible and get forgiveness. So they may want to stick to an 8-week period, but you do have the 24 weeks. Any loans after June 5th are 24 weeks. There is no option for 8 weeks, but what they came out and said that you can use any period you want up to 24 weeks. So if, for instance, if you're able to spend the money in 17 weeks and you believe you get full forgiveness, you can cut off at 17 weeks. The rehire rule was also changed, was 8-week and 24-week covered periods. You now have until December 31st to cure any FTE reductions that you had. Again, what we believe in our firm, and we have about 1,500 clients that receive loans, and our basic discussion with them is, wait till you can spend all the money that you can spend, and then not worry about the FTE reductions. We'll look at that, obviously, but in order to, if you have 24 weeks, you can have probably 50% reduction in FTEs and still get full forgiveness. So that's something to consider and to talk to your advisors about as you're going through this process. Next slide, please. So what they also did in this act was they changed the maturity date to 5 years. Originally, it was 2 years. Any loans after June 5th will have a 5-year maturity, still 1% interest. Now, this is the amount that's not forgiven. Now, we're all assuming that all of our loans are going to be 100% forgiven, so this will be a moot point. But you have 5 years. Now, any loans before June 5th, You can negotiate that with your lender. I believe most lenders will give you a 5-year term. Otherwise, if they don't, negative press. We heard all the negative press when the PPP first came out with some of the banks. So that's something. So again, if you do have some portion of the loan that won't be forgiven, you can probably get a 5-year term. The payment deferral interest extends the deferral period to the date the SBA remits the loan forgiveness to the lender. If no forgiveness, and this is important because I have a lot of clients call me saying, well, how long do I have to apply? I want to do it right away. Well, you have 10 months after the covered period. So if you think about the covered period being almost 6 months, then you have 10 months. So you almost have a year and 4 months before you actually have to apply for forgiveness. So there's a lot of time in there. So again, there's no real rush that we can see to file for forgiveness. Unless, of course, you have some extenuating circumstances where maybe you're selling the business or you need to get that forgiveness done right away. Next slide, please. So the Flexibility Act, what it did was, and this is an interesting slide, it added some safe harbors. There were 4 pre-existing exceptions, which we'll talk about in a little bit. But what this did was it added a couple of safe harbors. For instance, the borrower can document in good faith an inability to hire back employees between February 15th, 2020 and December 31st, 2020, or had an inability to hire similarly qualified. So if you let somebody go and then you want to bring them back, so say you furloughed some employees in the beginning because you didn't have the money, now you get the PPP loan and you want to bring those people back. If they say, no, I'm getting more in unemployment than you're paying me, then you can try to hire somebody that's similarly qualified. Now you have that exception. So if you can't hire them back, they refuse to come back, you're okay. You can just document that they refuse to come back, obviously have that in writing. But then you also must notify the state unemployment insurance office within 30 days of the rejected offer. So you need to tell the employee, by the way, you're not coming back. That's fine, but I have to tell the unemployment that I tried to hire you back. So that's, again, a move to get the money back. Remember, this is the Paycheck Protection Program. So this is all about protecting employees' paychecks. The next item here, the business activity. This is one that, it looks like it's a catch-all, should help a lot of businesses, but there is not a lot of criteria around this. If the borrower can document in good faith, again, document in good faith the inability during the covered period, whether the 8 weeks or 24 weeks, to return to the same level of business before February 15, 2020, due to compliance with requirements or guidance by the CDC, OSHA, or HHS. Now, the inability can be direct or indirect. So if you are a business that's servicing, say, the restaurant industry, for instance, we'll use that one as an example, and you supply them with supplies, well, if they're closed, obviously it's indirectly affecting you. You cannot get back to that same level of business. So you can use this safe harbor. You need to document that information, and Dan will talk a little bit about documentation. He might graze over it, but we do have information in some of these slides about the documentation. An example, the IFR that was issued on June 23rd indicated that a state shutdown order must reference the federal guidance. So again, you have to always document back to the federal guidance, even though the state had the shutdown. But that's safe harbor, and we believe that almost every business will be able to use this safe harbor. I have, though, because it's kind of vague in what the level of business is, I've been advising my clients to try to meet it with the FTE counts and reductions and do the full calculation, just because I don't know what that level of business means. What the Flexibility Act also did was it changed the 75-25 rule. What that was originally was you had to spend 75% on payroll and 25% could be on non-payroll costs. They changed that to a 60-40. And so if you spend 60-40, if you spend no more than 40% can be spent on other costs, other payroll costs, other non-payroll costs, and you can use that amount. So that was a help for a lot of businesses that were maybe heavily with heavy rent or had other costs that were not payroll, to be able to use that to kind of stay in business. Again, the purpose here was to kind of keep businesses afloat for the time being. Next slide, please. Polling question.
Okay, so I'm gonna launch the polling question. So what percent
So what percent of the PPP loans were under 150%? Please make your selection.
Okay, so we'll give it about 15 more seconds.
Wow, okay.
Looks like we're still getting a few more in. All right. Looks like we got mostly everybody, so we'll close it out.
Okay. And the are you going to post the on the screen, or I just read it off?
You could just read it off.
Okay. Well, 87% is the correct answer, and 68% of the folks got that one correct. The others were wrong. No big deal. But the key is to answer the questions. Okay. So the PPP Extension Act came out and was enacted on July 3rd. It extended the application deadline for 5 weeks. So that brought us to August 8th. The interesting part on that was that it closed on August 8th, which was a Saturday. I don't know why they picked a Saturday to close the loan process. But we heard a lot of clients trying to reach out to the banks, and most banks were saying, we're not accepting any applications after August 5th. And the reason they did that was because they had $130 billion were unused. The interesting thing on that was that they came out and started giving out money in the beginning, and started then coming up with criteria of why, were you eligible in the first place to get the loan. And a lot of issues circulated around eligibility. We heard Shake Shack, who was a public company, gave back their $10 million, and a lot of other companies followed suit because they were afraid of the certifications that they were signing on. I believe, and I think Dan does too, that we think most of the work by the SBA won't necessarily be on the forgiveness amount, but it will be on whether you were eligible to get the loan in the first place. So that's where I think they're going to spend most of their time. Next slide, please. So the loan forgiveness covered period, again, it defaults to 24 weeks, which begins on the first day that the loan was dispersed into your bank account. Paid or incurred rule still applies to payroll and non-payroll costs. What that is if you pay the expense during your covered period, or if it was incurred. So for instance, if you are in your 24th week and your payroll is a 2-week period which ends in the 25th week, as long as you pay the payroll in the 25th week, you can count the 24th week as part of your expense or payroll cost. So borrowers who have the loan before June 5th can elect an 8-week period. Again, the rationale behind that's a look at each item, each individual circumstance as it arises. There is an alternative payroll covered period that came out, and this was for administrative convenience. They were allowing businesses to use when their payroll started. So an example is if you received a loan on June 20th, but your first day of payroll for the 2-week period starts on April 26th, Sunday, and goes for 2 weeks, you're allowed to use that 8-week period or 24-week period, which would start on the 26th of April. That's only good for payroll. It doesn't qualify for all the other costs. So again, that's something that I don't see a lot of that occurring now with the 24 weeks, because most businesses will get the full use of the money within 24 weeks. Next slide. So loan forgiveness payroll costs. So this is an area that has changed several times. I'd like to say that we were on top of this. A lot of the things that had come out and had changed over time, I think Withum was in the forefront of putting out information, and we were pretty much correct in most of the instances that we had. But of course, I'm with Withum, so I'm a little biased. So non-payroll non-owner employees. So for C Corps, S Corps, the IFR that came out yesterday kind of clarified an issue that we all had, which was what is an owner? What is considered an owner? We have a big tech practice. And in the technology industry, a lot of the employees get stock ownership, and they might get 0.1%. Well, they're considered an owner. They're getting a K1. So we weren't sure if they were considered owner employees or not. And they came out with the IFR, said anybody less than 5% ownership in a C Corp or an S Corp does not have to follow the owner employee rule, which we'll talk about in a minute, which is very beneficial. So the cash compensation, which includes wages, tips, commissions, bonuses, and hazard pay, for the 8-week covered period is a cap at $15,385, which is your 100,000 cap, annualized 100,000 divided by 52 times 8. So when you got the loan, you divided by the number of months, 12 months, and then multiply by 2.5. Here you're going down to the weeks. A 24-week covered period, you'd cap out at 46,154. I will say this, I've got a lot of questions on this, and we'll probably get some more. If you decide to use a 20-week covered period, you would then take 1923, which is the monthly amount, which is the weekly amount that would get you to 100,000. Multiply that by 20, and that's the cap that you would have on the wages. Non-cash compensation for this group of employees. You can use the healthcare benefits. This is the employer portion of healthcare, and it includes vision and dental. The employer portion of the retirement benefits, 401k plans, union benefits, state and local employment taxes. Again, the employer's portion. These are in addition to those caps that I mentioned above, the 15,385. So somebody that capped out at 15,385 and you paid their 401k contribution or health insurance was another 10,000, that person would be having 25,385 allocated to them in total payroll costs. So owner employees, now if you're an owner, which is more than a 5% owner or a general partner, the 8-week cover period compensation is limited to the lesser of 8 weeks of 2019 compensation. So they're not looking at the 2020 comp, they're looking at the 19 comp, and you're limited for the 8 weeks to 15,385. For 24 weeks, you would be limited to 20,833. So notice there, you're losing about $26,000 of payroll for anybody who's a more than 5% owner in a business. Next slide, please. So payroll costs. So what are the payroll costs for C Corporation owner employees that are more than 5% or capped at the 2019 cash compensation, plus the employer state and local payroll taxes, healthcare contributions, and retirement contributions, capped at 2.5 months of the 2019 retirement contribution amount. The issue we were having here is, what if I pay that contribution, the employer waits to the end of the year, right? They don't pay it during the year, but they wait till before the tax return is due, and they pay in that, $300,000, which covers all the employees. Well, for owners, you're going to be capped at 2.5 months of what the 2019 amount was. So you will get some of it, but you won't get any more than that. S corporations, same situation, except that the health insurance of 2% or more owners is not included. Again, the assumption there is that should be included in their gross wages already. It's a little bit of unfortunately, it's in the gross wages, so it's counted in there. So S corps are kind of losing a little bit on the health insurance in that area. Schedule C filers, you're capped at owner compensation replacement amount calculated in 2019 net income on Schedule C line 31. So again, you take your Schedule C line 31, that's the amount from 2019. Theoretically, that's the amount that you got. Unfortunately, you cannot. Schedule Cs cannot get the retirement or health insurance contributions or any state and local payroll taxes. General partners, again, you're capped at 2019 net earnings from self-employment on Schedule K1, line 14A, reduced by the Section 179 deduction, and also any unreimbursed partnership expenses on Schedule E, and depletion in oil and gas multiplied by 0.9235. What they're doing here is pulling out the Social Security, the FICA expense. The employer's portion has to be pulled out. So that's something for partners that have to take that into consideration. They also cannot get any state and local employment taxes, retirement, or health care contributions for general partners in a partnership. Next slide, please. So what are the non-payroll costs? And this is that 40% that we talked about. So up to 40% of the amount that's spent can be used for this. And I just want a second here on the spend. If you got an $800,000 loan and you spend $1 million, the 800,000, it's 40% of the 800,000, so 320,000 is the most that you can spend on that, not the total spend. So I just wanted to correct myself there. Non-payroll overhead costs. So here you can take interest on any mortgage obligations on real property that were incurred before February 15th. The key here is the February 15th date in all these examples. If you have a contract or a lease prior to February 15th or a mortgage, you'll be able to use that. If you got a loan, a mortgage after February 15th, you cannot take the interest on that. Rent under a lease or real estate property or renewal of such lease does not include amounts paid to the subtenant. This came out in the IFR on yesterday. So what this is basically saying is if you have rent expense of $10,000 a month or $10,000, whatever for the year, and you have a subtenant that's paying you $3,000, you have to net it, and you can only use the $7,000 towards loan forgiveness in this example. Okay, so that's something that what we were getting those questions as well. My assumption was that you would net it all along, and this clarified it. Doesn't include household expenses in the case of a home-based business, unless those are already deducted on a Schedule C. So for instance, if you are a Schedule C and you have your home office and you never did it before on your 2019, but you say, you know what, I'm gonna take my 2020, I'm going to take some home office expenses. You won't be able to use those on your as a forgivable non-payroll cost. The rent paid to a related party is eligible for forgiveness if the amount of rent does not exceed the amount of mortgage interest owed on the property during the covered period that is attributable to the space being rented, and the lease and mortgage were both in effect prior to February 15, 2020. And what if there is a no mortgage on the property because it's subject up to the interest amount? It doesn't address it. And again, this is one of those things where a lot of information is being put out by the SBA, by U.S. Treasury, and it's very vague, and we have to interpret. So, and related party includes any common ownership. Utilities. So utilities before February 15, 2020 includes gas, electric, water, transportation. So you have vehicles. The gas for the vehicles can be used as a utility expense. The leases of a vehicle used in a business, I believe, is considered rent in the above. So in the construction industry, I know a lot of entities are leasing their equipment, they're not buying it outright. Those leases are considered rent. As long as they were in effect before February 15th, they would count. Telephone and internet also can be used towards those costs. So those are the costs for non-payroll costs. Again, that's capped at 40%. With that, next slide, please. Polling question number 2.
Number 2, so payroll costs include all the following except
Only 2% have voted.
I will give it about 30 more seconds. I have about 10 more seconds. Okay, I'm going to close it out.
Great. So 79% said FICA. I see the ones that answered 401k or health insurance contribution. You probably were thinking, I'm a Schedule C, Frank. You told me I couldn't take it. So I guess in that case, you guys are right. That would be correct. But also then you have a couple of answers are correct. But the most important one is you cannot take payroll taxes. The FICA payroll tax is not a includable cost. With that, I'll turn it over to Dan.
Great, thank you, Frank. And that was actually one of the questions that came in about what taxes are includable in non-payroll costs. The answer is it's just the employment taxes, so the SUI piece, not the withholding component of the taxes or the the employer share of FICA, that kind of thing. So okay, so now we're going to turn to the paid or incurred rule, which Frank mentioned briefly. We broke it out into two pieces here. It includes costs paid or incurred that are incurred before the covered period and paid during the covered period. So that's sort of think of it as the paid rule. The question here is how far in advance, how far back can you go? If your covered period starts May 1st, can you include January's rent? The answer is probably not. What they have said is if the expenses the prior month if this normally would be paid during the covered period, that can be included. Same thing with the prior payroll period, whatever that may be. So figure one billing cycle can probably be included there. That's incurred before but paid during the covered period. You can, even if you use an 8-week covered period, you can expand that a little bit. Recall that when this PPP first came out, they used an 8-week covered period. People thought it was too strict. Then they interpreted the paid or incurred rule favorably to expand it. Then they pushed it out to 24 weeks, which eliminated the need to tinker with the paid or incurred rule, or even any of these even the utilities and phone, internet, that kind of stuff. Largely irrelevant for most people because the payroll costs will dwarf the amount of the loan rendering full forgiveness for the vast majority of people. The second aspect here is the incurred rule, and so this is expenses that are incurred during the covered period and that are paid after the covered period, but on or before the next regular pay date. So if your covered period ends June 1st, but you don't pay your payroll until June 7th, that June 7th payment would be included only up to the payroll ending on June 1st. So you can include up to the end of the covered period, even if it's paid after the covered period. Then the SBA came out with these two rules here about group health care and retirement benefits. On the healthcare side, they said that the costs are includable to the extent they're paid during the covered period, but not for coverage outside the covered period, right? So they're somewhat limiting the healthcare costs. Again, this has changed over time, as Frank mentioned before. So many times they've gone back and forth with these rules. We spent a lot of time with this slide deck. It's been evolving over time. We do caution people, anytime you look at a slide deck or an article online, make sure you really focus on the date, because these rules have been changing rapidly, and what's current, in day one, a day or two later, it could be out of date. So there is a limitation here on the healthcare costs and the modification to the very broad paid or incurred rule. Similarly, with retirement benefits, they don't want you accelerating, paying a year's worth of retirement benefits in your covered period and saying that's all included. So you can't accelerate, the rest of your retirement for the year and jam it in the covered period. But you can include, as we said, more than 8 weeks in an 8-week covered period, more than 24. The rule generally is favorable. We used to spend more time with clients discussing this than we do now. Now it's just because of the 24-week covered period. As we say, most people will get full loan forgiveness. If you're not, most likely it's because you're not thinking about it properly, or you need to just focus more on the rules. Unless you have, which we'll talk about in a few slides later, severe headcount or wage reductions, you should be getting full loan forgiveness. And I'll talk about that in slightly more detail in a couple slides. But right now, so also the amount of loan forgiveness can't exceed the principal amount of the loan plus accrued interest. The way that works is, I just got this question yesterday from someone. If the loan is $100,000, the question is, what about the interest? And so let's just say the interest would be 1%. The application doesn't let you request forgiveness for 101%. But what they do is, when you have forgiveness, they're only charged interest on the amount that's not forgiven. So if you had 100,000 loan, you have 90 of forgiveness, you would be charged interest only on the 10,000 from the date you took out the loan at 1%. But if you have full forgiveness, the interest goes away as well. That follows the principal. Next slide, please. So this slide deals with how to eliminate headcount reductions, or FTE, full-time equivalent reductions. And this is one of those slides. I think there's probably 2 or 3 slides in this deck that really are great reference tools. One was one of them Frank mentioned about the limitations on owner employees for S corps and partnerships and self-employed individuals. This is another one of those slides for people who have any kind of FTE reductions. The rehire rule, which was right in the statute itself, I won't spend the time now. It's been beaten up. Nothing's changed really, other than you can restore FTEs by the 12/31 date rather than the end of June. But we've beaten that up many in prior webinars, and it's there's nothing new about it now. The 2 FTE safe harbors, and we're using the language of the applications here. We're not trying to, there's no real distinction between a safe harbor and an exception. They both give you the same type of relief. We're just sticking to the language the SBA uses when they describe these things. So Frank mentioned these 2 safe harbors on prior slides. And then finally, we have which we haven't discussed yet, are the 4 exceptions you can use to eliminate reductions. And these dripped in over time. One was the employee hours were reduced and the employee refused an offer at the same salary or wage to restore the reduction in hours. 2 is employees are fired for cause. 3, they voluntarily resign, or they request to receive reduced hours. So if you have a reduction in your employees or staff during the covered period for one of these reasons, you can ignore that reduction if you can fit it in. So a common question, not common, but a question we sometimes get is, what about, I have an employee who no longer works for me because he was called up on reserve duty, active reserve duty. And so the question for the company is, which bucket can you put this in, right? Can you fit it in any of these buckets to eliminate the reduction so there's no reduction in forgiveness? And what I have said, and not giving advice here, but that seems to fit in the voluntary resignation, right? They signed up for the reserves. It's not really I don't think the government's trying to penalize employers when their employees go serve, the reservists are serving an active duty in the military. Certainly the PPP does not want to punish companies for, they would want to encourage that sort of behavior. So it probably could fit in the bucket where the employee voluntarily resigned or requested to receive reduced hours during the covered period. So take your fact situation and try and fit it into one of these buckets, one of these 7 buckets here, the 4 exceptions, 2 safe harbors, or the rehire rule. Next slide, please. Some additional considerations we put here, and this is just to show that the exceptions or reductions need to occur during the covered period. So we just look at that example here in the middle of the slide where we say the borrower has a reference period of January to February of 2020. So that's when they're counting the FTEs to determine if there's a reduction during the covered period. As we call it the reference period. And then the covered period is April to mid-June, June 9th. And so on March 31st, an employee voluntarily resigns. The question is, can you take advantage of some of these safe harbors, exceptions, or rehire rule? And the answer is they cannot take advantage of the voluntary resignation, that exception we talked about on the prior slide, because it didn't occur during the covered period. But they can still take advantage of the rehire rule. And the rehire rule had a mid-February to end of April time period. So you need to look at this example here, just highlights that some of the exceptions are limited to, and then safe harbors are limited to what's done during the covered period. Others are broader. The last point here is what I want to mention. The gross spending is the starting point in the loan forgiveness calculation. And this is the reason most borrowers are going to get 100% loan forgiveness. So if you recall, a loan amount on the PPP was based on 2.5 months of payroll, so approximately 10 weeks. So now when you're looking at a 24-week covered period, you can see how the payroll is going to greatly exceed the loan amount, which gives rise to full forgiveness. So even with a substantial reduction in headcount and our wages, most people are still going to get full forgiveness. What I tell people is even with a 50% reduction, that's not likely to jeopardize full loan forgiveness. And we can walk through some math, but in the interest of time, we'll move forward. I know we have 5 or 10 minutes left of my presentation, and there's a lot of tax material to cover. Borrowers can submit the loan application anytime, even though they're bound by the 8-week or 24-week covered period. What this means is that, let's say at week 12, the borrower wants to submit its application, it can, and it will certify its application as of the end of week 12. The benefit is it can ignore any FTE reductions after week 12, since the application is complete at that time. However, the only thing the SBA has said that is any wage reductions in excess of 20% must be extrapolated to the end of the covered period. So if at week 12 you have wage reductions in excess of 25%, you have to extrapolate that reduction through the end of week 24 and then include that in your application at the end of week 12. But technically, when you apply early, you're using a 24-week covered period. You're just cutting it off at the date of your application. So there is no such thing as a 12-week covered period or 15-week covered period, 8 or 24, but you can apply early. The next bullet here talks about the SBA releasing information. They released a lot of information on borrowers, loan size, et cetera, on loans over 150,000, and they bucketed it so that the exact loan amount was not revealed, on the theory that if you reveal the loan amount, you're basically telling the world what someone's monthly payroll is, because they can just multiply by 2.5 to get the loan amount. And then for loans under 150,000, they didn't give names, they didn't give addresses, demographic information. They just aggregated the loan data. Next slide, please. And polling question number 3.
Okay, so I'll launch number 3 now. Can borrowers apply for loan forgiveness before the conclusion of their 12-week or 24-week cover period? Yes or no? So I'll give it about 45 seconds.
Good to see we got 100% got it right so far.
Okay, about 10 more seconds. Okay, I'm going to close it out.
And so 98% got it right. They said yes, borrowers can, of course, apply before the end of the 24-week covered period. Next thing we'll talk about here is loan repayment. The way the application process works, I won't spend too much time on this, the loan forgiveness application, is the lender has 60 days to review the application once it's received. Then it sends it over to the SBA. The SBA has 90 days. And then the SBA, they'll give a decision to the lender will notify the borrower. And so that's the process. It all goes through the lender. The SBA was behind the scenes. The borrower will not deal directly with the SBA. We anticipate that most loan forgiveness applications will be processed much sooner, especially given the volume that they have to complete, and that it's largely an automated process. The SBA contracted out with the fintech company to set up a portal. It's not a paper process. It's going to be through a portal. So we anticipate that, particularly for loans under 2 million, it's going to be largely an automated process, just given the time constraints and the number of volume of loans they have to process. Over 2 million, the SBA has announced they're going to review the loans for loan eligibility and for loan forgiveness. So that's going to be a longer process, more thorough review process. We also anticipate that they'll be conducting some sort of sampling, even if they automate most of the loan review decisions under 2 million, they'll probably have some kind of sampling process to make sure there's not widespread fraud or some kind of major error that most people are committing. Next slide, please. So the documentation requirements, we list them here. In the interest of time, I'm going to skip over this because we have we purposely left a full slide deck here so you can use it as a reference tool and go back to it and look things up. But in the interest of time, let's flip forward to, I think, the next slide and one more. Yeah, so the one point I want to highlight here about documentation. Everything's here on what you have to include on this and the prior two slides. But that third bullet in blue with the red, it says your borrower must retain all documents in its files for 6 years after the date his loan is forgiven or repaid in full. So this is a lengthy document retention requirement. And the thought here is the SBA wants to come review every loan, even after a decision on forgiveness is made. They want the ability to review the loan for eligibility and for forgiveness and come back and audit the loan. So they are requiring borrowers retain all the documentation in their files relating to the loan and the forgiveness for 6 years from the date the loan is forgiven or repaid. So you're looking at possibly 7, 8 years, maybe 7 years, yeah, possibly 8, 7 or 8 years after the loan was obtained. So a long tail to this document retention requirement. Next slide, please. There are 4 parts to the main application. Only parts 1 and 2 have to be submitted. Again, this year we expect that most loan portals from the banks will mimic the application. So you have the loan forgiveness calculation form and Schedule A. That's what's submitted to the bank. Schedule A worksheets retained by the borrower, and there's an optional demographic information form that's retained by the borrower. There's also an EZ application form, which is much simpler and requires certifications, which will be touched on later and later on in this hour. Next slide, please. So what's in the future of the loan forgiveness program? Then we'll turn to the tax very quickly. More changes are coming. There was Frank discussed that, or someone discussed earlier that possibly they're looking, JP Morgan looking at reducing the loan. The SBA would eliminate. There's legislation pending to reduce the loan forgiveness application process for loans under 150,000, and that's why on one of those first slides we listed the percentage of loans under 150 and 350. Both of these numbers have been thrown around in the press. If they eliminate, there are about 5.2 million loans were issued. If they eliminate 150 loans under 150,000 from the process, that eliminates about 87% of the loans. And if they go up to 350,000, that gets rid of 95% of that 5.2 million loans. They would just have a one-page application, no numbers, just certify good faith attempt to comply with the rules. And so there's likely to be something like that in the next stimulus round, just given the number of loans and the SBA's ability to process that many loans. The next thing is the latest Senate proposal for the second round of the PPP. Recall that the first PPP, there was a round 2 funding. They just added additional money into the program. This would be an entirely new PPP program. Some people call it the prioritized PPP or P4. But think of it as a new PPP program. The latest, if you read the press today, they said that I think the President's chief of staff said they're not likely to reach a deal until possibly end of September or into October. But what it would do is it would reduce, similar to the old PPP, but it would have a limit of 300 employees instead of 500. The borrower would have to suffer a 35% reduction in gross revenue in the first quarter or second quarter of 2020 versus the same quarter in 2019. So again, tightening the restrictions here, trying to get at the hardest hit businesses like the restaurants, movie theaters, etc., travel. Eligible borrowers are expanded, so there's more borrowers. The loan size would stay the same. The calculation, 250% of monthly payroll, but they cap it at $2 million. So none of these $10 million loans anymore. They would cap each borrower at $2 million. They keep the 40% cap, but they expand the list of expenses that are included in those non-payroll costs that Frank talked about, the rent, interest, and utilities. They would expand it to cover PPE, masks, that kind of stuff, sanitizer. Also expenses for adapting the work environment, software or cloud computing, costs related to vandalism, looting, or damage from protests. So they would expand the list of eligible expenses here, again, subject to that 40% cap. And additional ineligible businesses, they want to make sure that finance businesses and lobbying businesses do not obtain loans. So they would have additional exclusions from the program. So that's sort of a snapshot of what's the latest Senate proposal. Certainly the House is going to has its own view. So this is subject to the legislative process. Next slide, please. So we'll turn now to tax. We've broken this up into a few sections. On the receipt of a loan, obviously it's tax-free. That's the general rule. It applies to the PPP as well. Nothing unique here. Next slide. Loan forgiveness. Generally, when a debt is forgiven, that gives rise to cancellation of debt income or COD income. And so that is taxable. Normally, the general rule is COD income, cancellation of debt income, is taxable. Under Section 1106I of the CARES Act, they said that the COD income from forgiveness will be excluded from gross income, meaning it's not taxable. And so, but that only addresses the exclusion of the loan forgiveness. What about the expenses? The CARES Act never addressed the expense side of the equation, but the IRS did in Notice 2020-32, which is discussed on the next slide. We won't discuss this whole notice. Well, essentially what this notice did was it disallows the expenses giving rise to loan forgiveness. So if a $100 borrower gets a $100 loan, they spent $100, got full loan forgiveness. The loan forgiveness is tax-free, but the expenses are no longer deductible. And there is, I'll have a slide coming up next, I think, which will walk through a numerical example, but there are legislative proposals to reverse this notice, this IRS notice. So there's a Senate bill here, the Small Business Expense Protection Act of 2020. So this type of proposal may be included in the next round of stimulus. Next slide, please. This is an example just walking through the expense disallowance and how the effect of that is that the PPP loan forgiveness amount will be taxable to borrowers. I know that sounds odd because you've been hearing it's tax-free for so long. So let's just walk through a quick example. Look at the base case there, that second column. We'll walk down that column first. Income, this borrower here has 500, they had a 500, gross income of 500, expenses of 300, and they got a loan of $100 and they expect full forgiveness. So they have income of 500, expenses of 300, their net income would be $200. Now we're going to layer in COD income, nothing to do with the PPP yet. So go to the right, the next column. They have taxable COD income. So they have 500 of income plus 100 of COD income. They have total income of 600, same 300 of expenses. Now the net income goes up. It's now 300 instead of 200. No surprise there. The COD income increases the net income. Now we're going to layer it on even further. We're going to talk about this is the income with COD income and the COD exclusion that's in the CARES Act. And so there's 500 of income, no COD, it's been excluded. And then there's 300 of expenses, so back to 200 of net income. This is what people argue was congressional intent in passing the CARES Act to exclude that COD income. But then the IRS stepped in and we go to that last column. So this has the COD income, the COD exclusion, and the expense disallowance under that IRS notice. So you still have 500 of income, but now the expenses of 300 are reduced by the 100 of expenses that gave rise to the loan forgiveness. So the expenses are 200, the net expenses, meaning there's 300 of taxable income. And when you compare those last two columns in circles, you'll see the net income went up by $100, which is the amount of loan forgiveness. So the effect of the IRS notice is that the loan forgiveness amount is fully taxable to borrowers. And I know that's something that is unexpected and has some knock-on effects, which we'll talk about on the next slide, starting on the next slide. When is disallowance? I know this is a question. When does it occur? When are borrowers required to disallow? This is a question Lucas asked. I see in the questions. Section 265, which is the disallowance section, states that no deduction is allowed if it relates to tax-exempt income, which is the COD income under the CARES Act, it's tax-exempt. This is whether or not, and this is the underlined portion here, whether or not any amount of income of that class is received or accrued. So what they're saying here is the deductions are disallowed even if the loan forgiveness doesn't come until the next tax year. So in 2020, the borrower expects to receive 100% loan forgiveness. They apply, but they don't get a decision, let's say, until February of next year. And they file their tax return in January of next year. When they file their 2020 tax return, they're expected to disallow the expenses, making the loan taxable in 2020, even though they don't get a loan forgiveness decision until 2021. If they get the decision in time, they could then file the return correctly. If they get a decision, they can always amend the 2020 return. If they expected 100 of disallowance, forgiveness, meaning 100 of expense disallowance, but they only get forgiveness of 90, then they would have to amend the 2020 tax return. So that's the way the timing works out. You're expected to disallow the expenses even if the tax-free income is not received or accrued as to the end of your taxable year. Because the loan amount is effectively tax-free, this third bullet here says you have to increase estimated taxes during the year. So a lot of our clients we were reminding them to increase their estimated tax payments to account for the fact that they're going to have this 100 of extra income in the case of that example on the prior slide. If you have a client with a $5 million loan, it's a significant number, $10 million loan. They really need to account for that in their quarterly estimated income tax payments. Next slide, please. This next one talks about what to do if your loan forgiveness amount different from what you expected. We just talked about, and it talks about the difference between an amended and a superseding return. A superseding return is before the deadline expires. So let's just say an individual, you file a return in March and you realize by April 1st you made a mistake, you can fix it, and that's called a superseding return, not an amended return, because you're filing that before the deadline. If it's after the deadline, it's an amended return. Just walking through the process, and there's a special revenue procedure for BBA, which are partnerships, which are the BBA is a bipartisan budget act of 2015. It brought in a new audit regime for partnerships. So there's a special rule here. We don't have really time to run through it. Run to the next slide, please. This slide highlights something very important I think will be interesting to this audience. Self-employed individuals and general partners receive tax-free income, but they don't suffer the expense disallowance that other people do, because it's just there's no expense to disallow when you can't pay themselves, right? They don't write a check to themselves. So when a self-employed individual has loan forgiveness, that's the end of the story for them. So they can get tax-free income, unlike an employee of a corporation. So there's a disparity here. The IRS is aware of this. We don't know if they're going to address it, but they're aware of it. I spoke to the IRS about a month and a half, 2 months ago, someone at the IRS who said that they had submitted an FAQ to the SBA, but it hasn't been published yet. So they wouldn't even tell me what it was. They had thought it was published, but it wasn't. But they may be addressing this in some manner. We don't know if or how they're going to do that. Next slide, please. So now, okay, so with that, I'll turn it over to my colleagues at Withum to talk about the tax accounting for PPP loan forgiveness. Ron, do you want to start that? Or?
Thanks, Dan. Good afternoon, everyone. In this segment of the webinar, we wanted to briefly cover the accounting treatment of PPP loan forgiveness and the recent guidance provided by the AICPA. The loan program, as we all know, includes a lending and a forgiveness component, and many in the business community were confused and started to question how and when to account for the loan forgiveness in their financial statements. This lack of clarity in the marketplace isn't surprising because there isn't really any specific authoritative guidance in US GAAP that addresses how for-profit businesses should account for government assistance that we see under the PPP program. So this led to the FASB and the AICPA to get involved. And because of the quick turnaround needed to provide some solutions to the marketplace, the FASB requested the AICPA, this was probably back in May, for some ideas on how to proceed. And this resulted in the AICPA's technical Q&A 3200, which was published this past June. As we'll review in the next several slides, PPP loans under 3200 can be treated as debt obligations or potentially considered government grants. So how does my company account for the PPP loan received? I think the answer can be covered under 2 steps here. The first step is easy. Because the legal form of the PPP loan is debt, it's appropriate for a company that receives the loan to initially account for it as debt under ASC 470. And that's really regardless of whether the company expects the loan to be forgiven. The forgiveness component leads to step 2, and this is what 3200 primarily addresses. Before we move to the next slide, the last bullet point on this slide covers some commentary provided by the FASB. And the FASB said, regardless of the accounting approach that companies use, companies should be transparent with their accounting policy that includes clear and robust disclosures of the PPP loan in their financial statements. So folks, it's important to disclose how you're treating the loan in the notes to your financial statements, describe the accounting principles followed by the company, and the methods of applying those principles. Next slide, please. As I mentioned, the AICPA 3200 outlines two practical approaches of accounting for PPP loans and related forgiveness. But it opens the door to the possibility that a company which expects to meet the PPP's eligibility and loan forgiveness criteria can elect to account for the proceeds similar to a government grant. And we'll do a deeper dive on each approach in the next couple of slides. So let's jump right into approach A. Next slide, please. So under approach A, a business would, under ASC 470, recognize an initial liability for the full amount of the PPP proceeds received, and then accrue interest over the term of the loan at the specified rate, 1%, not necessarily at a market rate. And this is relatively straightforward. I mean, we all know how to account for a loan. But what about the forgiveness component under 470? Well, 470 punts it and refers us to ASC 405, which outlines the derecognition of a liability. And under 405, folks, it's clear when a business can recognize the extinguishment or forgiveness of the loan. The ASC specifically states the proceeds from the loan would remain recorded as a liability until either A, the loan is in part or wholly forgiven and the debtor has been legally released, or B, the loan has been paid off. So what does that tell us? Under this approach, the recognition of the loan forgiveness occurs when the legal release is received from the bank and the SBA. It's at this point, on the date of the legal release, the loan would be written down and the income from the extinguishment of the liability would be recognized in the income statement as a gain on loan extinguishment. You might wonder how long it could take to receive legal release. Well, as you see at the bottom of the slide here, a legal release could take up to 5 months from the date forgiveness calculations are submitted. Now, let's hope it doesn't take that long, but we'll have to wait and see. Things continue to evolve around this area. So this approach, treating it as debt and subsequent derecognition under ASC 405, it's straightforward, but a much more rigid or conservative approach of recognizing the forgiveness component compared to what we'll hear under approach B from Ron. So with that, I'll turn it over to Ron.
Thanks, Joe. So actually, what I just want to step back and also say to Joe's point, with this, not only are you setting up a adequate disclosure on your accounting policy, but you're going to have to make a couple of strong decisions whether or not you have to treat certain cash as restricted if it hasn't been spent, subsequent events with respect to the timing of the forgiveness and the legal, the legal submission of the forgiveness, and any potential impacts it may have on going concern. So with that, we also have to consider that since there's no specific authoritative guidance, the technical Q&A section 3200 actually is non-authoritative. So it is their opinion and their guidance that many are looking to right now. And the a little bit less conservative methods that we're looking at for this would be to look at this as a government grant or a grant type of accounting. With that, they're kind of giving you a couple of different ASC code sections to take a look at and to compare to. One is actually from the international standards, which typically in this scenario is going to be your least conservative methodology, whereas you are looking at evaluating how the proceeds are and will be used, and determining whether or not a portion of the loan will be probable of forgiveness. So when we're looking at the IAS model, we're looking at, is the PPP eligibility expected? Are they reasonably assured? Is it probable? They compare it to GAAP in the sense that reasonably assured is similar in definition as probable, that all conditions required forgiveness are met, And then can they conclude that they will receive all or a portion of the amount forgiven? That's kind of going to be tough considering, the IFRs are constantly being released. We just saw the 24th round where they're changing up the rules a little bit more. So when you come to your reporting year end, you have a lot of tough decisions to make, your clients do, with respect to how they're going to handle the approach. And the other model is similar to your contingent gain approach, and that is under 958. The company could treat the amount received as a conditional contribution, and the gain contingency accounting kind of steps in, whereas you're recording the funds still as a liability, but you will subsequently reduce that liability as you have qualifying PPP expenses. And the key here, though, is contingent release of debt and that it's been substantially met or explicitly waived. Gain is realized or realizable. So it's gonna throw you into some tough decisions. The conditions for grants, when it relates to this, the company can elect. In this case, it talks about showing the offset of the grant against the related expenditure or reporting it as other income. The next slide, please. Some of the other items to consider, especially if you're treating this as debt, is origination costs, issuance costs. They're still going to be considered as a direct reduction of the carrying amount of the loan, deferred, amortized. If the loan is forgiven, I would imagine you would be expensing those at the time of the forgiveness. Interest expense, since the loans provide for the deferral of interest and principal until the date of forgiveness is determined, or if forgiveness never happens, the period runs out 10 months. The interest method should be applied, so you should be accruing interest at 1% throughout the process. It's important to note that the last point I want to make here is that this is a fluid situation still. So in determining the proper accounting treatment, stay tuned, because I have a feeling there's going to be more on how to report this coming in the near future. Thanks. I think I will turn it over to Kim now.
We just have one last polling question before Kim hops on, so I'm going to launch that right now. So which approach do you feel your company would most likely take? Okay, so I'll give it about 45 seconds.
Yes, so far there's 2% voted, but both are with approach B, which is, of course, I'm seeing the changes here. Okay, all right. Yeah, conservatism. GAP is always conservative. The majority of the audience is going with approach A. It's interesting.
I'll give about 10 more seconds.
Okay, are we ready?
Okay, I'm going to close out the poll now.
Okay.
Okay, you're good to go.
Okay, so for the last 5 minutes, I lost internet, I lost our phones. I've been trying to get back on, and luckily got back on just in time for this. So if you're like me, you want to get your loan forgiveness application in ASAP. You've probably had a lot done on it already, and it's kind of like a hurry up and wait. So why aren't we able to file our applications? So JP Morgan Chase, which had the most loans, 29.2 billion, wants to delay the loan forgiveness applications until September. And then many of our local banks are following suit, except for community banks who tend to be allowing filing right now. And what I'm finding out is they're hoping Congress is going to come back and pass an automatic forgiveness. At the beginning, we were told that 87% was 150,000 or less, and 95% were loans of 350,000 or less. So if those loans can be automatically forgiven, the work of the bank goes way, way down. And they were hard pressed when this all started to get the loan applications processed in time. So I think they're very worried about the workload. But in the meantime, we got to hurry up and wait. And again, if you're like me, you're worried about year end and having everything wrapped up by year end, or at least by the time your audit is done, so that your financials look appropriate and you don't have to worry about timing differences. So that's really all I have to say about the delay in the loan application. But I've been curious as to why, and that's what they've been saying. So we decided, and I know we're low on time, so I'll do this quickly. We decided to just throw in a few things on the emergency loan forgiveness. Loan forgiveness. On the emergency family leave, because so many of the schools are changing their mind every single day, and I know we have employees that are worried about it, and we're worried about our staff. So what I found was on the New Jersey Department of Labor page, a really good brochure on what New Jersey workers need to know about the Family First Coronavirus Response Act. The website is on the slides, but in addition to that, the handout is available on your screen with the PowerPoint presentation. I'm sorry, I got frazzled because of the internet going down right before I had to talk. So if you go to the next screen, the Family First Coronavirus Response took effect April 1st, and the law requires 2 types of leave. I'm sure you've had many seminars on this, so I'm not going to read through it. But one thing to note that I know I was confused about, but I managed to get all the answers now, and consult your attorney if you run into a specific situation. But with the emergency family leave, what does that do to New Jersey, where New Jersey has paid family leave? And the brochure that you have actually does walk you through the order that you take things. And you cannot take both the emergency family leave and the New Jersey family leave. You want to pick one or the other. Well, if you go to the next slide, the next slide shows that for the family leave, you get 2/3 of your wages up to $200 a day. And that is higher than the New Jersey family leave. So people should be taking the federal in order to maximize what they can get paid during the 10-week period. The other thing that came to light is that if you had family leave in the last 12 to 24 months, 24 months for New Jersey, 12 months for federal, 90% of the time you cannot take this family leave, or you can only take what is left of your family leave. So if you took 5 weeks, you could only take 7 weeks now. There are a few exceptions to that relating to New Jersey allows you to take family leave for domestic partnership, and the federal government does not. And if you have a leave that New Jersey does allow, but the Fed does not allow, then you may be able to take the federal emergency leave again. So you do want to check specific situations with your attorney, but overall you cannot piggyback the 2 leaves. Next slide. And this is a sample, unable to work or telework during the corona emergency because they need to care for a son or daughter. The first 2 weeks are unpaid. The next 10 weeks are the 2/3 of wages, up to $200 a day. What you want to be careful of, you might have some people that took leave in the spring, and they already did the 2 weeks unpaid. You don't want to count that 2 weeks again in the fall. Furthermore, if they took 5 days in the spring, then they only have 9 weeks left. And you can take this intermittently, and that's something else that hasn't been spelled out in a lot of places. So if we have one employee who is able to work 4 days a week, and they're going to take 1 day of family leave on Fridays. Next slide. So for those of you in Pennsylvania, you can still use this as an example, but you would want to leave out the New Jersey paid sick leave, and the New Jersey unemployment you would replace with the PA unemployment. But this would be the order that your employees take. The 80 hours federal emergency paid sick leave, and that's capped. And then up to 1 week of New Jersey earned sick leave if you still have it available. And then if the employee wants to take their vacation, they can. And if not, then you have the next 10 weeks as additional weeks of family leave. And then from there, if they still need time, they go on New Jersey unemployment. So that is the order. And you notice there's no piggybacking of the New Jersey family leave on this. Next slide. So if you're caring for a loved one who is ill with COVID-19, this is what New Jersey says. 80 hours of federal emergency paid sick leave, 1 week of New Jersey earned sick leave or whatever you have left, and then 39 weeks of unemployment, and then up to 6 weeks of New Jersey family leave insurance can be taken instead of the 39 weeks. That New Jersey family leave comes into play here because you cannot take the federal family leave for caring for a loved one. Next slide. And that's it. The brochure that we have as a handout does really cover this well. And even if you're in Pennsylvania, you can just ignore the New Jersey parts, and it still tells you the order of leave and the amount that you pay. So that's all I have right now.
Excellent. This is Frank again. So there are some questions that came in. So Dan and I guess they're kind of towards us. So the first one I think was Lucas about the will I have to claim the forgiveness in 2020 or 2021? And I think Dan answered that question in that I believe that you would not be able to take the tax deduction for the expenses in 2020, even though you might not actually get an official letter that you were forgiven until 2021. Is that correct, Dan?
Yep. I addressed that while we went over the slide. I happened to see the question before, so.
Yeah. Okay. The next question is, if the company pays the union benefits, does that qualify to be included in the forgiveness, or is it just the health and welfare and pension expense? My belief is that it's just the health and welfare and pension expense. The dues part is not part of the as part of a cost that can be used for forgiveness.
Right, but I think the question sometimes is you need to find out what makes up that union benefits.
Mm-hmm.
Right, what is comprised of. Sometimes the benefits are included in there, the health insurance. Like if it's a component of it, you can break it out. You can include the health piece, but not the rest of it. To your point, Frank.
Yep. Yeah. That's correct. Go ahead.
If I could add to that, the annuity should be eligible as well, don't you think?
You described that, the annuity piece?
The annuity piece is another part of their retirement benefit.
Mm-hmm.
And in my research, we found that you could use the annuity.
Yeah. If I believe if it's towards retirement, because it doesn't like say 401k, it says retirement benefits. So right. I believe if that's a retirement benefit, then I would believe that would be included.
And you can double check that with your union. We did talk to our union, and then we talked to our CTA as well. And between the two answers, we decided that annuity could be included. But if you have any doubts, call your union and double check exactly what the annuity is for. Also, some of the unions have vacation and savings. And since the vacation pay is allowed, it just has to be part of wages and not part of benefits because they should be paying taxes on it. So it does affect your cap. So it might put a union guy over the cap on wages, but it's still more than you would have otherwise if you didn't use the vacation pay.
Okay, good. Next question. Does state local employment taxes include federal withholding or just SUI taxes? No withholding taxes are included at all. The only tax because again, that's part of the gross wages. So you're already getting that benefit. You're already getting the cost. So it would just be the employer's portion of the state unemployment insurance tax. And that's all you would be able to use for that. The next question, what if the FTE was injured and is on workers' compensation? That's a good question. Dan,
yeah, I
what do you
think, Frank, yeah, I think this goes to, there's no reduction here. There's no FTE reduction for this person. And the reason, again, this is where you put it into one of these buckets. I think you would say this is the person's voluntarily out of work or fired or was let go for cause. That's the FTE question. On the compensation question, they're getting workers' compensation, so you wouldn't double pay them. So I assume it's a reduction question.
Right. Yeah. Yep. And that makes sense. Again, you're not going to have the expense, and that's where what I mentioned earlier about the number of weeks that you use. One FTE shouldn't matter, even if it wasn't included, because you should have enough paid in if you go beyond 8 weeks that you'll still get full forgiveness, even if you have one FTE reduction. What happens if a new business, a Schedule C, started 1/1/2020? How is owner's compensation calculated and limited? The Schedule C also has employees. Well, I think you'd have to use, well, first, when you got the loan, you probably used the 2020 payroll because you had none for before 1/1/2020. So I would think you would use the same information for your covered period once you got the loan, right? Because I'm assuming you can't get the loan now. You're beyond the 8 weeks. So if you haven't gotten beyond the August 8th, so if you haven't gotten the loan yet, there's no money available for you right now. If you have gotten your loan, whatever number you got is, and I know the Schedule C you're supposed to use 2019. I believe that you would probably use the 2020 compensation, annualize that, and use that number. Dan, do you agree with that?
Yeah, I mean, you'd have to, because you don't have any other option. There's no number to work off of. I had thought, and this goes way back, I can't remember, these eligibility questions seem like they were ages ago, but they were, 4 months ago. It seems like a lifetime. Wasn't there some requirement, though, that you'd be in business for a certain time period? Do you recall the answer to that? I just don't remember.
I thought you had to be in business by February 15th.
So it's this year then? It was February 15th this year, not 19?
Yeah, I believe it's February 15th.
I think that's right. I'm looking quickly. I looked online, the questions for loan eligibility. I was seeing if I can get a quick answer, but that looks to be the case. But if you don't have the data, I mean, you can't use it. The question is, what about the limitation? I don't know the answer to that one.
Yeah, I'm thinking that you'd use the same limitation. So, I think you would annualize. You have an argument to annualize your 2020 compensation. So whatever your Schedule C is for, say you're using 6 months, you have through June, and you annualize that, that would be the amount. And again, remember, you're capped at $20,833 for the owner, and then the employees are capped at the 46 if you're using 24 weeks. Next question we have is, if you use a PEO, do you break out employee fee into workman compensation, FICA, unemployment compensation, healthcare costs, and PEO fees? If you use a PEO, do you break out the employee fee?
I mean, you're gonna, I don't know what that is, but you're gonna have to break it out because only certain pieces of those are includable in the application. Certain others are not.
Right.
So if you can't break it out, you can't include it.
Right. So the healthcare costs are all I see there that you would get. The PEO fees you're not going to get. The FICA you're not going to get, and the unemployment, again, the employer's portion. If it's the employer's portion, you would get that, but you wouldn't get the anything to do with any fees, they would not be counted. To confirm, will not be allowed to deduct expenses used in forgiveness in 2020, even though forgiveness is not granted until 2021. What happens if forgiveness is not granted and 2020 tax return filed not deducting expenses?
Well, then you go back and amend, right? That's the case. So they take the $100 loan and they expect full forgiveness in 2020. There's no COD income, as we talked about. You disallow 100 of expenses in 2020. And let's say in June of 2021, they learned they only got forgiveness of 90. In that case, they disallowed too many expenses. They disallowed 100 of expenses. They should have disallowed 90. So they would go back and amend at that point and amend the 2020 return to add back the 10 of expenses.
Right.
They would have more taxable income.
Yes,
And 10
agreed.
more.
Yeah, that makes the most sense, because you should know by the time you're filing your remember, your 2020 tax return can be put on extension. I know you're allowed to put extensions out there, right, Dan? So
Yes.
you can extend that until a corporation till September 15th.
October. You get 6 months in the extension.
Oh, it's October. So you have till October. So I would assume by October you should have a decision on how much money you had gotten forgiven. So that way you might want to, if you never got an extension before, this might be one of the reasons why you go on extension, just so that you don't have to file an amended tax return. Because as we all know, nobody likes filing amended returns, because we all think the government looks at those a little more closely.
Right, and Frank, for financial statement purposes, you may not have the luxury of extending past April 30th with many lending institutes. So you will probably find yourself in a situation where, if you account for it for financial purposes as a loan, you're going to have deferred tax considerations.
Maybe not, Ron. Because deferred tax, don't you have a more likely than not scenario?
True.
So I think if you use I think if you use, I'm stepping on your toes, but I am a peer reviewer, and I would think that if you use the more likely than not that it'll be forgiven, I think you may be able to overcome any deferred tax situation on that.
That's a good point. Good point.
And Frank, while you were answering that, I recalled that question was nagging at me. What do you do for a new business in 2020? I remember seeing something about it somewhere, and so I went online while you were doing the next question or two, and it is addressed in. So the person for Brian who asked that question, if you go to the document is on the website. It's the frequently asked questions on loan forgiveness. I think there's 26 of these questions. There's 2 FAQ documents. The one addressing loan forgiveness. Then you go to question. There's a subset for loan forgiveness payroll costs, FAQs. Then you go to question 8. It says it deals with this sole proprietor issue, self-employed individuals, and use your 2019 net profits as reported on Schedule C, line 31. And here's where it says, or for new businesses, the estimated 2020 Schedule C referencing question 10 of how to calculate your loan amount. So you're going to use the estimated 2020 Schedule C referenced in question 10. And then I'm going to question 10 right now. And question 10 just says, you fill out the Schedule C for January and February of 2020. So just use the January and February 2020 numbers. Anyway, so there's the answer. It's in that FAQ number 8 of the loan forgiveness FAQ questions. And that's question number 8 in the second category. It's on page of the document. It's on page 5. Here we go, real-time research right here on the webinar.
Good job. So I don't see any more questions, and I believe we were scheduled to end at 2:30 anyway. So with that, I will thank all of the panelists here speaking. We have, and here's our pictures and some of our email addresses. If you need any assistance with anything, please reach out to us. Like I said, you know, you can go to our website, withum.com. We have a lot of information there. And if you have any questions, you can reach out to any of us and we'd be happy to help you, walk you through the process. We understand there's a lot of anxiety here with this forgiveness amount and doing the calculations right. So we want to be here to help you. So thank you all for attending. Kim, any
Thanks,
last
everyone.
words?
Yes, thank you from South Jersey chapter. Withum, you did a great job as always, and we appreciate all your help. And we look forward to the September virtual seminar, which is on the umbrella market. I don't know if you all have renewed your umbrella yet, but there were some shocking numbers out there. And one of our competitors who does talk to us about certain things, he actually got a 500% increase with no notice from his broker. So it's crazy out there with the umbrella. So we're going to address that. And right now we're worried about where the healthcare is going to go. There was an article in the paper about Cigna and AmeriHealth wanting more of the COVID cases to go on workers' comp. So I think they're looking for a huge increase. So we're going to talk about the healthcare market in September as well. So look for that email. It should be a really great seminar. And again, thank you to everyone at Withum for, even there's people behind the scenes. Alana that works for them did a great job with the presentation and the poll questions and bringing us all together. So thank you to everybody. It was really good.
Thanks, everyone. Please remember to take a moment to complete the online survey. Thank you and have a great day.
Thank you.